Welcome. What is economic easing and quantitative easing? Economic easing, also known as monetary easing, refers to the actions taken by a central bank or monetary authority to stimulate the economy by making credit and borrowing easier and cheaper. This is usually done by lowering interest rates, buying government bonds or other securities, or increasing the money supply. The goal of economic easing is to encourage borrowing and spending by consumers and businesses, which can help boost economic activity, create jobs, and increase economic growth. It is often used during times of economic recession or slow growth, when traditional fiscal policies such as government spending and tax cuts may not be enough to stimulate the economy. However, economic easing can also lead to inflation if too much money is injected into the economy too quickly, or if the economy is already operating at full capacity. Central banks therefore need to balance the benefits of economic easing against the risks of inflation and other potential negative consequences. Economic easing can take several forms, including lowering interest rates. Central banks can lower interest rates to encourage borrowing and investment. When interest rates are lower, it becomes less expensive for businesses and consumers to borrow money, which can lead to increased spending and investment. Quantitative easing. In this approach, the central bank purchases government bonds or other assets from financial institutions, which increases the money supply and reduces interest rates. This can help boost economic activity by making it easier for businesses and consumers to access credit. Forward guidance. Central banks can use forward guidance to signal their intentions to keep interest rates low for an extended period of time, which can provide greater certainty and stability for businesses and consumers. Negative interest rates. In some cases, central banks may set interest rates below zero, which means that banks and other financial institutions would have to pay to hold deposits with the central bank. This can incentivize banks to lend money rather than hold onto it, which can increase economic activity. Overall, economic easing can help stimulate economic growth and provide support during times of economic difficulty. However, it is important to use economic easing judiciously, as excessive easing can lead to inflation and other negative consequences. Additionally, there are limits to the effectiveness of economic easing, particularly in situations where the economy is already operating at full capacity or facing structural challenges. Here are some additional points to consider about economic easing. Economic easing is usually used in conjunction with other policy tools. While economic easing can be effective in stimulating economic activity, it is typically used in conjunction with other policy tools, such as fiscal policy or regulatory measures. For example, during the pandemic, many governments used a combination of economic easing and fiscal stimulus to support the economy. Economic easing can have unintended consequences. While economic easing can be effective in the short term, it can also have unintended consequences in the long term. For example, prolonged periods of low interest rates can encourage excessive borrowing and risk-taking, which can lead to asset bubbles and financial instability. Economic easing can impact exchange rates. Economic easing can impact exchange rates by making a country's currency less attractive to investors. This can have both positive and negative consequences, depending on the specific circumstances. The effectiveness of economic easing varies depending on the economic context. Economic easing can be more or less effective depending on the economic context. For example, it may be more effective in a recession than during a period of sustained growth. The impact of economic easing can vary across different groups. The impact of economic easing can vary across different groups within society. For example, lower interest rates may benefit borrowers but may negatively impact savers who rely on interest income. Overall, economic easing is a complex and nuanced policy tool that can have both positive and negative consequences. It is important for policymakers to carefully consider the economic context and potential unintended consequences before implementing economic easing measures. Explain quantitative easing. Quantitative easing, K, is a monetary policy tool used by central banks to stimulate the economy by increasing the money supply and lowering interest rates. This is typically done by purchasing government bonds or other assets from financial institutions, which increases the amount of money in circulation and reduces interest rates. Here's how it typically works. The central bank creates new money electronically and uses it to purchase government bonds or other securities from financial institutions, such as banks. This increases the amount of money that these financial institutions have available to lend, which can reduce interest rates and make it easier for businesses and consumers to access credit. Lower interest rates can stimulate borrowing and investment, which can help boost economic activity, create jobs, and increase economic growth. In some cases, the central bank may also purchase other assets, such as corporate bonds or mortgage-backed securities, to further stimulate economic activity. Quantitative easing is typically used during times of economic recession or slow growth, when traditional monetary policy tools such as lowering interest rates may not be enough to stimulate the economy. By increasing the money supply and reducing interest rates, they can help increase economic activity and boost inflation. However, there are also potential downsides to quantitative easing. For example, it can increase the risk of inflation if too much money is injected into the economy too quickly, or if the economy is already operating at full capacity. Additionally, they can lead to asset bubbles and financial instability if investors become too reliant on low interest rates to fuel investment. Finally, there are concerns that K can exacerbate income inequality by benefiting investors and those with access to credit at the expense of savers and those on fixed incomes. Here are some additional points to consider about quantitative easing. Quantitative easing can have global implications. Since many countries are interconnected through trade and financial markets, the impact of quantitative easing in one country can have global implications. For example, the U.S. Federal Reserve's quantitative easing programs in the aftermath of the 2008 financial crisis had a significant impact on global financial markets and exchange rates. The effectiveness of quantitative easing varies depending on the economic context. The effectiveness of quantitative easing can vary depending on the economic context. For example, it may be more effective in an environment where interest rates are already very low, as the impact of further rate cuts may be limited. Quantitative easing can impact the value of a currency. Since quantitative easing involves increasing the money supply, it can lead to inflation, which can reduce the value of a currency relative to others. This can have both positive and negative implications for a country's economy. Quantitative easing can impact asset prices. Quantitative easing can lead to an increase in asset prices, particularly in stocks and real estate, as investors search for yield in a low-interest rate environment. However, this can also lead to asset bubbles and instability. There are limits to the effectiveness of quantitative easing. While quantitative easing can be an effective tool for stimulating the economy, there are limits to its effectiveness. For example, it may not be effective if there is a lack of demand for credit or if there are structural issues in the economy that need to be addressed. Overall, quantitative easing is a complex and nuanced policy tool that can have both positive and negative consequences. It is important for policymakers to carefully consider the economic context and potential unintended consequences before implementing quantitative easing measures. Like, comment, subscribe, to follow along for the trip.